Good afternoon, everyone. Today we are going to go over the adjusted trial balance in accounting. So later on in class, what we'll do, we'll go over how to do an adjusted trial balance or what the accountant actually does. So as bookkeepers, you may be doing just the unadjusted trial balance, then the books is handed over to the accountant to do the adjusted trial balance. But this is just to give you an overview. So last class, we talked about the cost of the chart of accounts. And then we moved on to the unadjusted trial balance. Today, we're going to look at what is on our bank statements. On our bank statements, we may have some missing transactions, like bank fees. We may have some service fees, late fees. We're going to look at accruals, money that is coming in that we have not yet received. We are also going to look at depreciation, a little bit of depreciation in our books. We're going to look at our deferrals, and we will also look at what we call our tax adjustment. So these are some of the things that we are going to look at in terms of definition for today. Now, what was our chart of accounts? 1 was for assets, 2 was for liabilities, 3 was for equity, 4 is for income, and 5 is for our expenses. So let's talk about the definition of an adjusted trial balance. An adjusted trial balance is a list of all the final balances in all accounts, and this is where the adjustments have been made. Again, all the final balances in all accounts, and this is where the adjustments have been made. So what are we looking at? We're looking at the missing transactions, for example, bank fees. That's very common. You look at your bank statement, you have a late fee, you have a service charge in your bank statement that is not in your books. Then we're going to talk about accruals. Accruals are what? Accrued revenue. You did the mechanic job in December, but up till now, in January, you didn't get paid. In deferrals, mechanics and constructions do this. I've seen that in my family construction. My father, who is now passed away, his construction. Right? He has to collect money before the job is finished. That's deferral revenue. Because what happens? If you don't collect money up front, many people don't pay you. And that has been the experience in my few years, seeing my dad doing construction. Seeing other people do mechanic jobs, the mechanics say to you, oh, you have to pay for the parts, you have to pay for the service up front before they actually start your job. Then another thing that is very common is depreciation. When you have a small business, the moment your truck or your car comes off the lot that you use in your business, it starts to get depreciation. Then you may have some tax adjustment. IRS may give some tax credit, and that is what you're going to use. So these are the various little transactions. And here is a sample of what a adjusted trial balance would look like. And what are we trying to do? We're trying to ensure that all of the debit balance are equal to all of the credit balance. So we have listed in here a depreciation expense, some bank service fees. Your bank service fees would be affected by your cash. So your bank account would go down. So thank you again for listening. See you in class, and make sure you study the definitions. So when we practice them in class, this will be easier. Thank you. Have a superb day.